Imagine you could control $10,000 worth of stock for just $200. Not owe anyone anything you can't afford. If the stock goes up, you profit as if you owned all $10,000 of it. If it goes down, the most you can ever lose is that $200. Honestly, it sounds like a trick, but it's completely legit, and it's a financial tool that's been around for decades. It's called an option, and by the end of this video, you'll understand exactly how it works, the hidden forces working against you, and the risks that most beginner explanations skip entirely. Welcome to Martic Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. Here's the simplest way to think about an option before we touch a single financial term. Imagine you want to buy a house. You're not ready to commit yet, but you don't want someone else to snatch it up either. So you pay the seller a small non-refundable deposit, say $2,000 for the right to buy that house at today's price, anytime in the next 3 months. If the house becomes more valuable, you can still buy it at the price you locked in. If you change your mind, you simply walk away. You only lose your $2,000 deposit, nothing more. That deposit is the entire idea behind an option. You're not buying the asset. You're buying the right to buy or sell it later, at a price fixed today. That's the whole concept. Everything else is vocabulary. Now, let's put names on the pieces, using our fictional company, currently trading at $100 per share. The premium is the price you pay for the option itself, like that $2,000 deposit. Let's say it is $2 per share for our example, and options are sold in contracts of 100 shares, so one contract costs $200 total. The strike price is the price you've locked in, the price at which you're allowed to buy or sell later. In our case, $100. The expiration date is the deadline. After this date, the option is worthless if unused, like that 3-month window on the house deposit. Let's say ours expires in 1 month. The contract simply bundles all of this together. The right, tied to 100 shares of the company, at a strike price of $100, expiring in 1 month, for a premium of $200. 2 more words you'll hear constantly. A call option gives you the right to buy at the strike price. A put option gives you the right to sell at the strike price. All right, now let's follow a fictional investor. We'll call her Anna, who buys one call option. The strike price is $100, expiring in 1 month, and the premium is $200. Our fictional company is currently at $100. Over the next month, 3 things could happen. Scenario 1. The stock rises to $120. Anna's option lets her buy 100 shares at $100 each, even though they're now worth $120. She could exercise the option, immediately buy at $100, and sell at $120. A $20 per share gain, or $2,000 on 100 shares. Subtract her $200 premium, and she's made $1,800 profit from a $200 investment. That's the leverage effect. A small move in the stock produced an enormous move in her return. Scenario 2. The stock stays flat at $100, or drops slightly, say to $95. There's no reason to buy at $100 when the market price is lower, or the same. Anna simply lets the option expire unused. Her total loss is the $200 premium, nothing more. This is the critical safety feature of buying options. Your downside is always capped at what you paid. Scenario 3. The stock crashes to $50. The outcome for Anna is identical to Scenario 2. She still only loses her $200. It doesn't matter how far the stock falls. Her risk was fixed the moment she bought the contract. Notice the shape of this. Anna's potential gain is theoretically unlimited if the stock keeps rising, while her potential loss is fixed and known in advance. That asymmetry is the entire appeal of buying a call option. Every option has 2 sides. If Anna bought the call, someone sold it to her. Let's call him Marco. In the real market, the person on the other side of a trade like this is often not a random individual. It's frequently an institution, a market maker, or an investor deliberately running an income strategy. For our example, Marco is playing that role. Someone willing to accept a smaller certain payment in exchange for taking on a larger, less certain risk. Marco collected Anna's $200 premium up front. That money is his to keep, no matter what happens next. In exchange, he's taken on an obligation. If Anna decides to exercise, he must sell her 100 shares of the company at $100, even if the market price is much higher. Let's run the same three scenarios from Marco's perspective. If the stock rises to $120, Marco must sell shares worth $120 for only $100 each. If he already owned those shares, he's giving up $2,000 of value beyond what he's already collected in premium. A real opportunity cost. If he didn't own the shares and has to buy them at $120 just to hand them over at $100, his loss is $2,000 minus the $200 premium he collected, or $1,800. The higher the stock climbs, the worse this gets for him. In theory, without limit. If the stock stays flat or drops, Anna won't exercise her option, and Marco simply keeps the $200 premium as pure profit. This is the mirror image of Anna's position. Marco's maximum gain is capped at the premium he collected, while his potential loss is theoretically unlimited. Now it's time to talk about put options. A put option gives its buyer the right to sell at the strike price, useful when you think a stock will fall, or when you want to protect a position you already own. Say Anna instead buys a put option. Strike price is $100, the premium is $200, and expiring in 1 month. If the stock drops to $70, Anna can sell shares at $100 that are only worth $70, a $30 per share gain, or $3,000 on the contract, minus her $200 premium, $2,800 profit. If the stock rises or stays flat, there's no reason to sell at $100 when the market price is equal or higher. Anna lets the put expire, losing only her $200 premium. The seller of that put, Marco again, collects the $200 premium up front. If the stock falls, he's obligated to buy shares at $100 even though they're worth less, and his losses grow the further the stock falls. If the stock holds steady or rises, he simply keeps the premium. Same shape as before, just mirrored. Buyers of puts have capped risk and large potential reward when prices fall. Sellers of puts have capped reward and growing risk as prices fall. There are 3 words you'll see on every option screen you ever look at, and they simply describe where the stock price sits relative to the strike at any given moment. Take Anna's call option again. Strike price $100. If the stock is trading above $100, say $110, we say the option is in the money. It has real immediate value. Anna could exercise it right now and probably profit. If the stock is trading exactly at $100, we say the option is at the money. There's no immediate profit from exercising, but there's still time left for that to change. If the stock is trading below $100, say $90, we say the option is out of the money. Exercising it would mean buying at $100 something worth less on the open market, so there's no reason to. It still might regain value before expiration, but right now it has none. For put options, it works in reverse. A put is in the money when the stock is below the strike, and out of the money when the stock is above it. Here's why this matters beyond vocabulary. An option that's out of the money at expiration simply expires worthless. But, and this is critical, an option that's in the money at expiration is not automatically a profitable trade. Why? Because the stock can be above the strike price and still not have moved enough to cover the premium Anna originally paid. If the stock rises to $101 on a $100 strike call, Anna's option is technically in the money by $1 per share. That's $100 of intrinsic value on the contract, but she paid $200 for it. Exercising gives her back $100, but she's still down $100 overall. This brings us to the break-even price, the single most useful number for any option buyer. For Anna's call option, with a $100 strike and a $2 per share premium, her break-even at expiration is $102 per share. The stock needs to be above $102 for her to see any profit at all. For a put buyer, it's the reverse. Break-even is strike price minus the premium paid. If Anna had bought a $100 strike put for $2 per share, her break-even would be $98. The stock needs to fall below $98 for her to turn a profit. The premium isn't just a fee, it's a hurdle you have to clear. Always know your break-even before you enter a trade. Everything so far has focused on where the stock price ends up, but there are two additional forces at work in every single option, every single day, and they're the parts beginners almost never get taught, right up until they cost them money. The first one is time decay. An options premium isn't just about intrinsic value. It also contains something called time value. Extra money buyers pay for the possibility the stock could still move in their favor before expiration. That time value shrinks every single day, automatically, purely because there's less time left for the stock to move. Picture Anna's $200 premium sitting on a lit fuse the moment she buys it. If the stock does nothing at all for 3 weeks, just sits at $100, that option isn't worth $200 anymore. It's worth less and less and less, even though nothing went wrong. By the time expiration arrives, if the stock is still sitting at exactly $100, the option is worthless. Not because Anna was wrong about the direction, but because she ran out of time for her prediction to matter. And this decay isn't linear. It accelerates. An option loses value slowly when there's a lot of time left, and rapidly in its final days and weeks. This is precisely why so many first-time option buyers are blindsided. They correctly predict a stock will eventually rise. Buy an option. Watch the stock do nothing for a few weeks and lose most of their money to time before the move they predicted ever arrives. And the second force is implied volatility. Option prices aren't just about the stock price and time. They're also influenced by how nervous the market is. When investors are scared, during earnings announcements, economic uncertainty, or market crashes, option premiums get more expensive. Think of it like insurance premium. If you're insuring a house in a hurricane zone, the premium is higher than for a house in a calm area. Same house, same value, but the perceived risk changes the price. Options work the same way. When markets are calm, options are cheap. When markets are fearful, options are expensive. Implied volatility doesn't just stay high, it can collapse overnight. Imagine Anna buys that $200 call option when implied volatility is high. Right before an earnings report, she pays extra for all that nervousness. The earnings report comes out, the stock barely moves, but the fear evaporates. And suddenly her option is worth $80, not because the stock went down, but because the market stopped being scared. That's the volatility crush. If you are a buyer, like Anna, time decay is always eating your option, and a drop in volatility will crush you. If you're a seller, like Marco, you are going to love this. Right now, he can actually do one of two things. Option A, take the money and run. Marco can spend $80 to buy the contract back right now. By doing that, he locks in a clean $120 profit in less than 24 hours. The trade is completely closed. He walks away, and he never has to worry about that stock again. Now, you might be wondering, how can Marco sell a contract he doesn't even own yet? In the regular world, you have to buy something before you can sell it. But in the stock market, you can actually do it backward. When Marco sells this option, he is essentially creating a debt. The market hands him $200 in cash, but his account now says he owes -1 contract. To wipe out that debt and close the trade, he eventually has to buy a contract back. If he buys it back when the price drops to $80, he pays off his debt, his account goes back to zero, and he pockets the $120 difference. He successfully sold high first and bought low second. And there is also an option B, wait for expiration. Marco could also choose to do absolutely nothing and wait weeks for the expiration date. If the stock stays flat, the option eventually shrinks all the way to $0, and Marco gets to keep the entire $200 premium. So why wouldn't he just wait every single time? Well, because of risk management. Leaving a trade open means leaving yourself exposed to danger. If Marco holds on for weeks just to squeeze out that last $80, a random bad news headline could drop tomorrow, send the stock flying, and wipe out all his gains. Before we move on, we need to clear up the biggest misconception about how people actually make money here. In every textbook, they tell you that if Anna buys a call option, her goal is to eventually use that option to buy 100 shares of the stock. But in the real world, almost nobody does that. Instead, Traders just buy the contract, wait for it to increase in value, and then sell the contract itself back to the market for a cash profit. Think of it like buying a ticket to a massive sold-out concert for $100. If that band suddenly becomes the biggest thing on the planet, people might start paying $500 for that exact same ticket. You have two choices. You can actually go to the concert, or you can just resell the ticket online for $500, pocket a clean $400 profit, and go home. In the options market, everyone is just reselling the ticket. In fact, using the option to buy the actual shares early is usually a massive mistake. Because if that ticket still has a week left on the clock, its price includes a premium for that remaining time. If you use it to buy the stock early, that time value instantly evaporates into thin air. You're throwing money away. Instead, the smart move is to sell the contract itself, take the full cash value, and walk away. There are some exceptions though, and these are the main ones. If you really want to hold the stock for the next 10 years, if the company is about to pay a massive dividend that's worth more than the time left on the clock, or if the option is illiquid and you can't actually sell it at a fair price, in that case, exercising might be the only realistic way to capture the value. Otherwise, remember, you aren't marrying the stock. You're just trading a flexible piece of paper that moves with it. You'll often hear that options are just gambling. That's a fair description of how some people use them, but it's not what they are. Here are 3 real common uses. Hedging. An investor holding shares worried about a short-term drop might buy a put option as insurance. If the stock falls, gains on the put offset losses on the shares. If it doesn't, the investor simply loses the premium. Income. An investor who owns shares of a company and doesn't expect a big rally might sell call options against those shares, a strategy called a covered call. They collect the premium as income, with time decay working steadily in their favor. If the stock doesn't rise past the strike, they keep both their shares and the premium. If it does rise past the strike, they may have to sell their shares, but they still keep the premium. Speculation. As with Anna's original trade, an investor with a strong view on where a stock is headed can use options to control a large position for a small amount of capital, amplifying returns, but also amplifying the chance of losing that capital entirely, especially if the move takes longer to arrive than the option has time left, or if implied volatility drops after they bought. We've talked a lot about the risks for buyers, but sellers have their own hidden risk. It's called assignment risk. In the US, most stock options are American style, which means the buyer can exercise their right at any time before expiration, not just on the expiration date. Imagine Marco sold Anna that call option. If the company announces a massive dividend, and suddenly it becomes profitable for the option holder to exercise early to capture that dividend, Marco could wake up tomorrow to find he's been assigned. He has to deliver those shares, often with very little warning. Here is a quick visual summary worth pausing on. Buying a call. Your maximum loss is limited to the premium you pay, while the potential profit is theoretically unlimited. However, time decay works against you, and a drop in volatility can also hurt the position. Selling a call. Your maximum profit is limited to the premium you receive, while the potential loss is theoretically unlimited. Time decay works in your favor, and falling volatility can also benefit you. However, there is always a risk of being assigned. Buying a put. Your maximum loss is limited to the premium you pay, while the potential profit can be substantial if the stock price falls significantly, with the maximum gain occurring if the stock falls to zero. Time decay works against you, and falling volatility can also hurt the position. Selling a put. Your maximum profit is limited to the premium you receive, while the potential loss can be substantial if the stock price falls to zero. Time decay works in your favor, and falling volatility can also benefit you. However, there is always a risk of being assigned. Buying options is generally lower risk in dollar terms, but has a real common outcome. Many options expire worthless, meaning the full premium is lost, even when the underlying prediction turns out to be directionally correct. Selling options generates more frequent small profits, but carries the possibility of a large, sometimes severe, loss, and that loss can happen at any time, not just at expiration, due to early assignment. Alright, and before we wrap this up, I would like to clarify something. Options are powerful, but they're also completely unforgiving. So here's the deal. If you're watching this because you're genuinely curious about how options work, awesome, that's exactly why I made this. But if you're watching this because you're about to open a brokerage account and start trading options, please don't. Seriously. Or at least start with an amount you're genuinely okay with losing, because in most cases, you will. And that's all for today. Thanks for watching, and I'll see you very soon. Bye.